Greetings to you all and welcome to the lesson. We are going to answer question number 2. Explain the following terms as used in mergers and acquisitions: poison pill, staggered board of directors, golden parachutes. Now the first one, poison pill, we know is a defensive tactic that is used by a target company to deter hostile takeovers. Okay, it is a defense tactic that is used by target companies by hostile takeovers, and it involves creating a situation where the acquisition becomes less attractive or financially unfeasible for the acquirer. Poison pill, and we know that poison pill can take various forms. For example, the target company may issue rights to the existing shareholders, entitling them to acquire a large number of shares in the event an acquirer's stake in the company reaches a certain level. So that is a poison pill. I'm giving an example, is where the target company, the company that is targeted through a hostile takeover, issues rights to existing shareholders that will enable them to buy the shares of the company in the event of a hostile takeover. Do you understand? Candidates were to just explain in brief: poison pill, it is a defensive tactic used by a target company to do what? To deter or to stop hostile takeovers. Then Roman 2 is a staggered board of directors. Staggered board of directors is also known as classified directors. It is also known as a classified board. A staggered board can also be known as a classified board. A classified board. A classified board. And what is a classified board? This is a structure where the board of directors terms are staggered so that only a portion of that board is up for election each year. It is a situation whereby not all members of a board are up for election in a given year. We have a section of the board, for example, being elected in 1 year, then another section in, say, 2 years or 1 year. So their election is staggered. And this means it would take several years for an acquirer to gain control of the board, even if they acquire a majority of shares in the company. Do you understand? Do you understand? And the structure is designed to provide a stability and continuity in corporate leadership, and can also act as a defense against hostile takeovers by making it more difficult for an acquirer to quickly replace a board with their own nominees. So if a company is to acquire another company, the company that is to be acquired may have a staggered board of directors, all right, where the board of directors terms are staggered so that only a portion of that board is up for election each year. So even if the company is acquired, it becomes very impossible for the new shareholders to take control of the company by appointing their own nominees to sit on the board. That is the meaning of a staggered board of directors. Then you have golden parachutes. Golden parachutes. Golden parachutes. These are what I may call lucrative. They are lucrative packages or compensation, lucrative compensation that is offered at the end of employment to the top executives. So golden parachutes are lucrative severance packages, which is to mean high packs that are offered to top executives in the event of change in control of a company. And such packages often include substantial cash payments, they include stock options, they may include other benefits. So the purpose of golden parachutes is to retain talent. One purpose is to retain talent. These golden parachutes can help to attract and retain top executives by offering financial security in case of a takeover. Another purpose for golden parachutes is to reduce resistance. All right? Because there are times when the board of directors can resist mergers or acquisitions. So by offering them these golden parachutes, which are substantial compensations, that reduces resistance to a takeover by removing the executives' financial incentives, all right? The executives' financial incentives to oppose the deal. So a golden parachute, in brief candidates, these are lucrative payments that are offered to the top executives so that they can reduce resistance to takeovers. It's 2 marks. Then part B of this question reads, Tobin Limited is appraising an investment project which has a cost of 20 million shillings payable in full at the start of the first year of operation. The project life is expected to be 4 years. Forecast sales, volumes, selling prices, variable costs, and fixed costs are as follows. So we are given the data for year 1, year 2, year 3, and year 4. Additional information number 1. Selling price and cost information are in current price terms before applying selling price inflation of 5% per year, variable cost inflation of 3.5% per year, fixed cost inflation of 6% per year. Number 2, Tobin Limited pays annual corporation tax of 30%, with the tax liability being settled in the year in which it arises. Number 3, the company can claim tax allowable depreciation on the full initial investment of 20 million on a 25% straight line basis. Number 4, the company's investment project is expected to have zero residual value at the end of 4 years. Number 5, Tobin Limited has a nominal after-tax cost of capital of 12% and a real after-tax cost of 8%. Number 6, the general rate of inflation is expected to be 3.7% per annum for the foreseeable future. Required, the nominal net present value of Tobin's Limited investment project. So here we are to calculate the NPV of this project, and we have seen that the initial investment is 20 million, because that is the formula for calculating the NPV. So we know that NPV is equal to present value of cash inflows minus present value of cash outflows minus present value of cash outflows. So we need two inputs here: the present value cash inflows and total present value of cash outflows. We have the outflows. What we require is the present value of cash inflows, and we have the data provided in the table there. Sales the units per year: 300,000, year 1, 410,000, year 2, 505,000, year 3, 220,000, year 4. Then you have selling price per unit: 125 shillings, 130 shillings, 140 shillings, and 120 shillings respectively. We have variable cost: 71 shillings, 71 shillings, 71 shillings, 71 shillings for each year. Then there is the annual fixed cost of 3 million, 3.1 million, 3.2 million, and 3 million respectively. So this, in calculating the cash flows, candidates, we are required to make adjustments for inflation. You can see in note number 1, the selling price and cost information are in current price terms before applying the selling price inflation of 5% per year, variable cost inflation of 3.5% per year, and fixed cost inflation of 6% per year. So we have to adjust the selling price, the variable cost, and the fixed cost. We have to adjust with the inflation rates provided. So you will help me do that. So we're going to have a table. Here, because this is the formula. Anything else that you are going to do falls under workings. We've seen we have the sales, the variable cost, the fixed cost. All this you are going to deduct in order to determine the operating, the profit after tax, because we also have the tax rate. We are going to determine the cash flows after tax for each year. Then we get the total present value cash inflows. Then we deduct from the initial investment of 20 million. So first we have sales, 4 years. This is year 1, year 2, year 3, year 4. So you'll have the sales. We need another special working for sales. It's working 1. Then we also have We have variable cost. There is a working for variable cost which will be required. What else do we have? So we'll have sales, variable cost, then contribution. We deduct variable cost from sales to get the contribution. Then from the contribution, we are going to deduct the fixed cost, which has to be adjusted for inflation. So you'll have a working for fixed cost, working 3. Okay. So do you have any other thing here? After deducting the fixed cost from contribution, we'll have the cash flows before tax. Cash flows before tax. Then of course we'll have the tax. You'll have the tax, corporation tax. Then you can see in note number, after deducting tax, candidates, in note, I saw something like tax, what was it? The company investment is expected to have 0 residual value. The company can claim tax allowable depreciation, can claim tax allowable depreciation on full, yes, you have tax allowable depreciation benefit. That will be added to the amount we, let me put some space there. Yeah, that's it. Tax allowable depreciation benefit. We'll have to add it back. Tax allowable depreciation benefit. Then we'll have cash flow after tax. After adding the tax allowable depreciation benefit, after adding it to the cash flow after tax, then we'll have the cash flow after tax. Cash flow after tax. Cash flow after tax. Then of course, after the cash flow after tax, we are going to discount. We'll discount the cash flows at the rate of 12%. We're going to discount the cash flows at the rate of 12%. Then after discounting the cash flows, of course, we'll have the present values. So that is the formula for calculating the present values. That is the formula for determining the present values. So we'll have the present value for year 1, year 2, year 3, year 4. Then we'll aggregate the present values, and that will be what will be deducted. We'll use these present values. The total amount will be the present value cash inflow. Then it will be deducted from the 20 million initial investment. So that is the formula for calculating the present values. So we come back to sales. Sales amount, note number 1, the selling price. The selling price, inflation is 5%. And the selling price per unit, from the information there you can see, is 1 125 shillings. So that 125 shillings, we are going to increase it by 5% year 1. Then it will be increased in year 2 by 10%. In year 3, it will be increased by 15%. In year 4, 20%. So I'm giving you this information because I want you to do that work. I will not be calculating for you today. I want you to practice. I want you to practice. So please make sure you have your calculator and you have a notebook. So I'm giving you the formula. First of all, you have, this is the formula. Then we are going to first of all have the sales. So to calculate sales, these are workings. These are workings within workings. Workings within workings. Do you have a question? Workings within workings. So working number 1 is the sales revenue. This sales revenue working 1. Sales revenue working 1. Okay? Sales revenue working 1. Sales revenue working 1. And I've said we are going to increase this revenue. Selling price. So we have year 1, year 2, year 3, and year 4. The sales price per unit is it 125? 125 shillings. Year 1, year 2, 130, year 4, 140 shillings. Year 5, this is year 3, year 4, 120. So these selling prices are increasing by 5%. Are increasing by 5%. The inflation is 5%. Inflation of 5%. There is inflation of 5%. So for year 1, it's going to be 1.05 times 125. Year 2 is going to be 1.1 times 130. Year 4, 1.15 times 140. Year 3. Year 4 is 1.2 times 120. So we increase the prices by 5% every year. 5% every year. So then that is the selling price per unit, which will then multiply by the number of units. Year 1 is 300,000, year 2 410,000, year 3 505,000, year 4 220,000. So give me the sales revenue. Sales, what is the sales revenue? Our case says year 1, 131.25. 131.25. I think that is inflation. 300,000. That is 300,000. 410,000. 410,000. 525,000. 220,000. These are units per year. So the amount, the inflation you get there, which according to RK is 131. Give me the sales revenue for year 1, year 2, year 3. So it is just this times that times that. What is the sales revenue? Sales revenue, Magdalene says 3937, 39,375, 39,375, 39,375, 000, 000. Keep going. So this is 39,375, 000. It should be under sales. $39,375,000. Second year, 58,630, 58,630, 58,630, 58,630, 000. Year 2, year 3, year 3, 84,525, 84,525, 84,525, 000. Year 4, fourth year, 31,680, 31,680, 31,680. That is year 4. Then we move on to variable costs. Variable costs. Working to variable costs. So you have variable costs per unit. The variable cost per unit is 71, 71, 71, 71, 71, 71, 71. 71, 71, 71. The inflation is, inflation for variable costs is 3.5%. 3.5%. 3.5%. Now, candidates, for the variable cost, you can see the variable cost is constant. Year 1 up to year 4 is constant at 71 shillings. Constant at 71 shillings. And therefore, the inflation rate will be 1. This will be 1.035 times 71. How much is it? Kevin says 73,484. 73.485. For year 2, it's going to be 1.035 times 73.485 per year, because this is constant. It's not like for cells where it was varied. If it is constant, then you increase at 1.035. How much is it? 76.06. 76.06. Year 3, 1.035 times 76.06. 78.72. 78.72. Year 4, 1.035 times 78.72. How much is it? Then we have number of units. Number of units 300, 410, 525, 220. So multiply the new prices with the number of units, give me the variable cost working to 81.48. 81.48. So what is the variable cost year 1? 22,045. 22,045. 22,045. 22,045. 500. 22,045. 500. Year 2, 31, 184. 31, 184. 31, 184. That is according to RK. 31, 184, 600. 600. Year 3, someone says 41, 41, 328. 41, 328. 0, 0. 0, 0, 0. 4th year. 4th year. 4th year. 17,925. 17,925. 17,925. 0, 0, 0. 17,925. 600. Deduct. Get the contribution. Give me the contribution. Contribution. Year 1 contribution 17,329, 500. 17,329, 500. Year 2 contribution 27,445. 27,445. 27,445. 27,445, 400. Year 3 43,197. 43,197. 43,197, 0, 0, 0. Contribution year 4 13,754. 13,754, 400. 13,754, 400. Then we need to have a working for the fixed costs. Working 3, fixed costs. The fixed costs per, we have annual fixed costs of 300. 3 million year 1, 3.1 year 2, 3.2 year 3, 3 million year 4. And these fixed costs have to be inflated by 6. You need to adjust inflation of 6%. The inflation is 6% per annum. The inflation is 6% per annum. Okay, 6% per annum, and you can see the fixed cost is not constant. Annual fixed cost, year 1 is 3 million, year 3, where is year 3? Year 3, 3.1 million, year 4, 3.2 million, then year 4, 3 million. These are the annual fixed costs, which you are told will be increasing by 6% per annum. 6% per annum. 6% per annum. So year 1 will be 1.06%. 1.06%. 1.06%. Then year 2 it will be 1.2%. It is increasing by 6%. By 6%. That is 1.12. 1.12%. Then we have 1.18%. Then the last year is 1.24%. So now give me the product. Year 1, what is the fixed cost year 1 after adjusting depreciation, inflation of 6%? 1.16. 1.16. Should be 1.16. Okay, 1.16. How much is it? Year 1, 3 million by 6%. 3 million by 6%. 3180. Is it 3180? Confirm, please. Is it 3180? Fixed cost. Yeah, 3180. So fixed cost here. So RK, if you have 3180 here, don't delete it from the calculator. Just give me the cash flows before tax. Deduct the 3180 from the 17,329. Cash flow before tax. RK, cash flow before tax. Cash flow before tax. Cash flow before tax. Instead of rubbing this, then you punch in again. If you have 3180, deduct it from that amount. Give me the cash flow before tax. 14,149. 14,149. 500. 14,149. 500. Then let's do fixed cost year 2. What is the fixed cost year 2? 1.12 times 3100. 3472. 3472. 3472. Deduct it from 27, 445, 400. Give me the cash flow before tax. Cash flow before tax. 23,973. 23,973. 23,973, 400. Now give me the fixed cost year 3. 1.18 times 3.2 million. Kevin says 3776. 3776. 3776. Deduct it from contribution. Give me the cash flow before tax. Deduct it from contribution. Give me the cash flow before tax. 421. RK 39,421. 39,421. 39,421. Candidates, we are now working on speed. Speed. Drop the digits. Give me the fixed cost year 4. 1.24 times 3 million. 1.24 times 3 million. 1.24 times 3 million. RK says 3720. 3720. 3720. Deduct it from the contribution. Give me the cash flow before tax. Deduct it from contribution. Give me the cash flow before tax. Magdalene says 10 what? 10,034. 10,034, 400. 10, that's so. 10,034, 400. Then what is the tax? Apply 30% tax on the cash flow before tax. 30% of 141,450. 42,44,850. 42,44,850 is the tax. Year 2, tax year 2, corporation tax year 2, 71,92. 71,92,020. 71,92,020. Year 3, tax year 3, 11,826. 11,826. 11,826, 300. Fourth year, corporation tax, 30,10,320. 30,10,320. 30,10,320. 30,10,320. Then we need to have a working for tax allowable depreciation benefit. Tax allowable depreciation benefit. Tax allowable depreciation benefit. Tax allowable depreciation. We learned that the company can claim tax allowable depreciation on the full initial investment of 20 million on 25% straight line. The depreciation is 25% straight line. So the depreciation tax shield will have a working here. The depreciation tax shield will be equal to the depreciation expense times tax rate. We'll calculate the depreciation, and we are told that the depreciation is straight line. The company can claim tax allowable depreciation on the full initial investment of 20 million on a 25% straight line basis. So each year depreciation will be 25% of the 20 million, because we saw that the scrap value is 0. So the depreciation charge per year is 25% of 20 million. Then we apply the taxation rate. This is going to be the depreciation tax shield per year. How much is it? And it's going to be constant because it is straight line method. 25% of 20 million times 30%. How much is it? RK says 1.5 million. So 1.5 million, 1.5 million, 1.5 million, 1.5 million. So we are adding it. So give me these figures. Cash flow before tax, deduct the tax, add back the depreciation benefit. Give me the cash flow after tax. So what is the cash flow after tax year one? Cash flow before tax, deduct corporation tax, add back tax allowable depreciation benefit. What is the figure year one? Kevin says 11404. 11404. 11404. 11404. 11404. 650. Year 2, 18281. 18281. 18281. 18281. 380. 380. Third year, 29094. 29094. 29094. 29094. 700. 29094. 700. Last year, RK says 8524. 8524. 8524,080. These are cash flows after tax. Then we discount at the rate of 12%. Give me the factors, discounting factors. This you read from the tables. Read from the table. This can be read directly from the table. Discounting factor, the first factor, 1 over 1.2 raised to 1. If you don't have a table, it is the formula is 1 over 1.2.12 raised to 1 year 1. Year 2 is 1 over 1.12 raised to 2. Give me the factors. Read from the table, so calculated. Year 1 is 1 divided by 1.12 raised to 1. Kevin, 89, 29. So Magdalene, 89, 29. Don't give me the next one. Multiply by the cash flow after tax. Give me the present value. Multiply that figure directly there with the cash flows after tax. Let's have the present value. 10,183 to 12. 10,183 to 12. I've rounded off. Correct, to 12, Magdalene. What is the next discounting factor? The next discounting factor, it should be 0.7 something. This should be 0.7 something. Then the next one will be 0.7972. 7972. multiply by the cash flow after tax. Let's have the present value. Our case is 14,573. 14,573. 14,573. 14,573. 916. 916. Year 3, it should be 0.7 something. Year 3, discounting factor, year 3, discounting factor, year 3, 0.7118, 118, multiplied by the cash flows after tax. What are the present values? 2709, 2709, 2709, 2709, 607, 607. Then this should be 0.6 something. Discounting factor year 4, 0.6355, 6355, multiplied by the cash flows after tax. Let's have the present value. Kevin says 5417. 5417. 5417. Magdalene confirms 052. 052. 052. Then add all these present values. What we are looking for. Add all these present values. Give me the total here. We deduct it from the 20 million. What is the total present value of these cash flows? Magdalene says 5883, 5883, 5883, 5883, 5883, 5883, 787, 787, deduct 20 million. That will be, this will be 30, 883, 787. That is the NPV. 8 marks. 8 marks. 30,883,787 is the net present value. The net present value.